Hey everyone, welcome back to our channel Polo Vega. Hope you've been enjoying all our videos so far. Today we're going to talk about currency and foreign exchange. Before we start talking about currency and foreign exchange, let's look at the disclaimer/disclosure clause. The contents of this presentation are for information purposes only. The material has been obtained or derived from sources believed to be accurate, but we do not guarantee its accuracy. The presentation is the seventh of a series of interactive videos aimed at educating our viewers about currency and foreign exchange, as the knowledge of interest rates remains incomplete without learning about currency and foreign exchange, popularly known as forex. The topics that we're going to speak about today are currency versus money, interrelationship of interest rate, inflation, forward rate of exchange, spot rate of exchange, and expected rate of exchange, currency risk, hedging, and finally forex as a powerful money-making tool. Currency. Currency is the primary medium of exchange in the modern world after having replaced the barter system a long time ago as the means for trading goods and services. Currency is a generally accepted form of payment issued by the government and circulated within its jurisdiction. It's money in the form of paper and coins. One can say that it's a tangible form of money, whereas money is an intangible system of value. Having talked about currency versus money, let's now see the differences between the two. Money is a broader term that refers to an intangible system of value that makes the exchange of goods and services possible. Money is used as a variety of ways or related to its future use in some kind of transaction. It's a store of value. Money is also referred as a unit of account. It can be used to establish changes in the value of goods and services over time. Money is fungible or exchangeable, and it does not need to be revalued at each transaction. It's durable and can last for many transactions. It's convenient to carry and divide. It's recognizable so that people can confidently complete their transactions and exchange it for goods and services. Having spoken about currency and money on our last slide, now we look at the interrelationship between interest rate, inflation, spot exchange rate, and forward rate of exchange. Interest rate parity theory says that the difference in interest rates between two currencies must be equal to the difference between the forward and spot exchange rates between the two currencies. As per the expectations theory of exchange rates, the percentage difference between the forward rate and today's spot rate is equal to the expected change in spot rate. The law of one price, or in more general sense, purchasing power parity, implies that any difference in the rates of inflation will be offset by a change in the exchange rate. Capital market equilibrium requires that real interest rates be the same in any two countries. Bonds don't promise a fixed real return, but they promise a fixed money payment. Therefore, the difference in money rates will be equal to the expected difference in inflation rates. All of the above are valid where individuals are not worried about risk and there are no barriers or costs to international trade. This slide shows us the interrelationship between spot exchange rates, forward exchange rates, interest rates, and inflation rates for economies A and B. So if there is a difference in interest rates between the two economies, represented by the ratios 1 plus RA divided by 1 plus RB, then this is going to be equal to the difference between the forward exchange rate and the spot exchange rate between the two economies, which is F A by B divided by S A by B. Also, the difference between the forward exchange rate and the spot exchange rate is going to be equal to the expected change in the spot rate, which is E S A by B divided by S A by B. And this is equal to the expected difference in inflation rates between the two economies, which is E 1 plus IA divided by E 1 plus IB. In other words, whenever there is a difference in interest rates, or if there is a difference in the forward exchange rate and the spot exchange rates, then it provides an opportunity to make money in one economy as compared to the other, and there is a cash flow from one to the other until such time that people cannot make any more profits. Having spoken about various situations where there is a chance of people making profits because of differences in expectations or differences in interest rates or differences in forward or spot rates of exchange, we can see that there is a risk associated with currency at all points of time. Currency risk is also known as exchange rate risk, and it arises due to the variation in the price of one currency up against the other. It arises due to the continuously changing market expectations with continuously changing inflation, interest rates, growth expectations, employment and wage growth, consumption and production, expansion or contraction, and changes in other key performance indicators of one economy vis-a-vis other economies. If there is a risk associated with currency or exchange rate movement, then there also has to be strategies to manage this risk. Investment in foreign assets has proven the merits of diversification, but it brings along the negative effect of currency risk affecting the overall return from the asset. Currency risk can be hedged through one of the following strategies to mitigate or completely eliminate the risk. The first one is buying currency ETFs, which move in an opposite direction to the hedged currency. Then we have the forward contracts, which lock the exchange rate at a slight premium to the existing spot rate. And the third one is buying options contracts, where one can get the opportunity to buy or sell at the strike price if the currency moves in an adverse direction. However, there is also a premium associated with this one, which is paid at the time you buy the option contract. Since there is a continuous movement of the price of one currency against the other as a result of varying market expectations, forex can be used as a powerful money-making tool. With its high liquidity and seamless 24-hour market with little or no chance of trading inside information, forex markets provide a free and fair trading opportunity to everyone and makes forex a powerful money-making tool. Forex markets operating seamlessly between 5 p.m. Sunday New York time until Friday 5 p.m. New York time provide an opportunity to trade currency pairs on all kinds of time frames. Following charts show the weekly, daily, 4-hour and 1-hour trading charts of GBP USD pair, commonly known as cable. We hope that you enjoyed our short video presentation on currency rates, difference between currency and money, relationship between interest rates, inflation, forward and spot rates, currency risk and hedging, and finally an introduction to the forex as a money-making tool. If you enjoyed our short video presentation, then please give us a thumbs up and press the button underneath to subscribe to our channel Polo Vega. In our next video, we shall talk about forex markets and FX trading in greater detail. Until then, please keep saving, keep investing, and keep getting wealthier. You may also visit us at our website www.polovega.com or contact us on our Twitter handle @PoloVega. We thank you all for watching our video and look forward to see you next time.